Hi there, tax accountants. I hope all is well, and I pray that as you viewing this video that you're in the best of health and spirit. This video will cover Chapter 3, Business Income and Expenses from Income Tax Fundamentals 2025. By the end of this chapter, you should be able to complete a basic Schedule C, profit or loss from business. As we know, for federal income tax purposes, the basic form is a Form 1040. And depending on an individual's situation, they might need to use other forms. There's Schedule A, B, C, D, E, and F. There's Schedule 1, 2, 3, and there's a plethora of forms. And in this chapter, we're going to focus on self-employed individuals that utilizes a Schedule C, profit or loss from business. We are going to describe the tax treatment of inventories and cost of goods sold, identify the requirements for deducting transportation expenses, identify the requirements for deducting travel expenses, determine the requirements for deducting meals, because as we'll come to learn, even though you utilize meals to maybe engage customers, either current or potential customers, they are not fully deductible. There were some changes during COVID. However, for the most part, meals are limited to 50%. We'll identify the requirements for claiming business education expenses. We'll identify the tax treatment of dues and subscriptions. We will determine which clothing and uniforms may be treated as tax deductions, explain the special limits for business gift deductions, explain the tax treatment of bad debt deductions. Bad debt, that's simply either you lent money to an individual or you essentially provided services to a client on account, you reported it as income and they did not pay you. So in such case, because you previously reported it as income under the accrual basis method of accounting, however, that income was never actually received, you can actually deduct that amount. We will ascertain when a home office deduction can be claimed and how the deduction is computed. And then lastly, we'll apply the factors used to determine whether an activity is a hobby and understand the tax treatment of hobby losses. So we start off with Schedule C. In Schedule C, as it relates to the Internal Revenue Code, a taxpayer who operates a trade or business or practices a profession as a sole proprietorship or a single member LLC, they are treated as a disregarded entity. Therefore, they are required to file a Schedule C with their Form 1040 or Form 1040 SR. And this form essentially reports their taxable income or their loss from that activity. So when you think of Schedule C, essentially it's similar to the income statement in financial accounting. It's all of the revenue and then all of the expenses. So taxable income from a business or profession, you are going to use this form. And then there's a specialized version of a form. If the individual is engaged in farming and ranching activity, they would use Schedule F, which is a specialized form. So trader business, based on the Internal Revenue Code, it is essentially any activity engaged in for profit. And when we get to the last learning objective, when we talk about hobby losses, we're going to see why this is important. So there are some tests for deductibility. So one key thing to keep in mind is that expenses, they need to meet several tests in order to qualify as a tax deduction. So sometimes you see on social media where there are these quote unquote tax professionals, tax gurus that are sharing information that's not necessarily always accurate, right? Because there are some requirements that need to be met. So for an expense to generally be considered deductible for a trade or business, it must first and foremost be ordinary and necessary. There must be a legitimate business purpose, and it needs to be reasonable in light of the fees that are generated as a result of the expense. The code does restrict the deduction of certain expenses, such as personal, living, and family expenses. So this is something to definitely keep in mind, especially when you are dealing with business clients. For the most part, sometimes they will use their business bank account to pay for personal expenses. So that's where you'll essentially need to ask them additional questions like, hey, I see this charge to Amazon. Is this business related or is it for personal? Any capital expenditures? Expenses related to tax exempt income, Uncle Sam says, hey, if you are not claiming, this income as income, therefore the expenses related to the generation of that income, it's tax exempt as well. Any expenditures related to the sale of illegal drugs, any illegal bribes and kickbacks, fines, penalties, and other payments to government officials related to the violation of law, any lobbying and political expenditures, any settlement or attorney fees related to sexual abuse or harassment if subjected to a non-disclosure agreement. So as it relates to Schedule C, taxpayers who operate a business as a sole proprietorship, they are required to file Schedule C to report the profit of loss. But before we carry on, just going to give you guys just a quick oversight as it relates to just these, three requirements. So the ordinary and necessary, essentially ordinary and necessary is governed by Section 162. And what that basically means is that, again, let's say an individual, they have a business. I'm a tax professional. So if I have a tax business and I go and I buy a yacht to take my clients on, Uncle Sam might say, what is this? Is this ordinary? Is it necessary? Versus someone who is in real estate and they sell luxury homes. In such case, for them purchasing a yacht to, tour and to show potential clients homes, in that case, it might be ordinary. It might be necessary in that case. So as you see, it can obviously change. And this ties into the second requirement where there's a business purpose test. There must be a legitimate business purpose in order for it to be considered deductible. And lastly, it needs to be reasonable, right? So if an individual, they can go and purchase a similar yacht for, $500,000. However, they bought the yacht for 1.5 million. Uncle Sam might be saying, wait, hold up. Is it reasonable? So obviously, as we see, based on the situation, it being ordinary, necessary, having a legitimate business purpose and being reasonable, things can change based on the facts and the circumstances. So just wanted to point that out. So here we go. There are 5 parts of the Schedule C. So as we know, used by sole proprietors and single member LLCs, and it is similar to the income statement, or also referred to as the profit and loss. So there's 5 parts of Schedule C. Part 1 starts off with the income. Part 2, expenses. Part 3, cost of goods sold. Part 4, vehicle information. And Part 5, other expenses. So as it relates to the income section, so this is where the individual is going to calculate their gross income for the business or the profession. So this is before any expenses and anything of that nature is taken. You're going to start off with the gross receipts or sales, which is reflected on line 1, and then essentially on line 2, if there were any returns, any allowances that were made to the clients, customers in such case, that is going to be reported. And then from there, we get our cost of goods sold. That's also going to be factored in, because especially when you are dealing with businesses that sell products, if you want to make money, you have to spend money. So in such case, in the event that I purchase a bottle of water, let's say for $1, and I resell it for $2, my gross receipt is $2. However, my cost of goods sold is $1. Therefore, my gross profit is only $1. And then on line 6, that's where you report any other related income from the business. So I'm actually going to pull up a Schedule C so that way you can actually see what it looks like. So that way, we are not just making up things. So here we see with the 2024. So this is what we're just referring to on part 1, where we have the income. And again, gross income. And then from there, part 2 shows all of the expenses. So in the event that, let's say there's an expense and you don't necessarily see a line item. So let's say that it's for, well, we have advertising, let's say it's marketing, right? So some things can fall under like a subcategory, because for the most part, advertising and marketing kind of, go hand in hand. But in the event that there's an expense that you don't see a line item, 27A is where you would input that amount. So there's a section, part 5, where there are other expenses. You just list these, and then the total amount of all of these other expenses would transfer to line 28. Then part 3, we have cost of goods sold. So how are they tracking the inventory, right? Is it going to be based on cost, lower of cost to market, or another method with inventory? We know that it's tracked based on LIFO, last in, first out, FIFO, first in, first out. Maybe it's the weighted average method. So part 3 reflects cost of goods sold. Part 4 would be vehicle information. So as we are going to learn, based on the number of business miles you drive, there is a deduction, a cent per mile, that is designated each year per mile. So this is essentially what the Schedule C looks like. And again, sole proprietors, single member LLCs, they utilize this form. So for individuals that file the Schedule C, whenever taxpayers have net earnings of $400 or more, they are required to pay self-employment taxes. So this is the equivalent to being an employee. You as the employee, you pay 6.2% for Social Security and 1.45% for Medicare. Likewise, your employer matches that portion. As a self-employed individual, you are considered both the employee and the employer. So just to wrap your mind around it, self-employment tax is essentially equivalent to FICA taxes as an employee. So with that being said, for self-employment taxes, individuals that file Schedule C, they also need to file Schedule SE with their Form 1040. And as mentioned, the self-employment taxes are made up of two taxes: Social Security, and here we see 12.4% because again, the employee portion is 6.2, the employer portion is 6.2 for a total of 12.4%. And much like as an employee, there is a capped amount for 2024, it's 168,600. It is increased for inflation each year. And the Medicare tax doesn't matter. If you make 168,600, if you make $1 million, it doesn't matter. There's no cap on the Medicare tax. It's 1.45% for the employee, 1.45% for the employer, for a total of 2.9% on all net self-employment income. And, if you think about it, someone might say, well, why would I want to be self-employed if I have to pay both the employee and employer portion? So in light of that, an individual does get to take a deduction for adjusted gross income that's equal to 1/2 of the self-employment tax. So when we factor all of that in, much like being an employee, the individual, they are only responsible for 7.65% after this deduction. So 6.2% for Social Security and 6.45% for Medicare taxes. So next we move on to inventory. So inventory, as mentioned, this is essentially an individual that sells physical products. They purchase products for resale. So as it relates to inventory, it's a stock of good a business holds to sell and make a profit. Cost of goods sold is often the largest expense for manufacturers, retailers, and wholesalers. So logically speaking, if we have an individual or a business rather that provides services, they're probably not going to have cost of goods sold because they didn't purchase any goods. They are providing a service. Inventory accounting involves measuring the ending inventory by doing an actual account. Small businesses that have gross receipts that are less than 30 million, they can account for inventory using one of three options under the cash method. They can treat it as non-incidental materials and supplies. They can treat it the same as on the applicable financial statements of the business, so according to how they handled it for GAAP purposes, or they can treat it as it conforms with the business's books and records. Most businesses, they're going to need to determine the value of the beginning and the ending inventory in order to calculate the cost of goods sold. And inventory accounting involves measuring the ending inventory, again, by doing an actual account. And there's two commonly used methods of inventory flow: first in, first out. So that would essentially be like a grocery store, right? For the most part, especially when it comes to produce, the items that came in first are more than likely to spoil first. That's why, for the most part, anytime I go grocery shopping, I always choose from the back, right? Just a little tip, hint, hint. All right, so first in, first out. So that would be an example of inventory on the FIFO, last in, first out. That's essentially where the items that were purchased last are sold first, under the assumption this would be like retail companies, right? For the most part, if they want to report a lower net income, in such case, the items that were most recently purchased are more expensive, ultimately resulting in a lower net income. So a taxpayer, they might need to adopt the LIFO method by using it in a tax return and attaching Form 970. And if the LIFO election is made for reporting taxable income, it also needs to be used for preparing financial statements. So there's some key things to keep in mind. There needs to be some conformity based on how it's being reported for financial purposes, for GAAP purposes, versus how it's been being reported for tax purposes. So something to keep in mind. And we saw it previously on the Schedule C, where inventories will be reported in Part 3, cost of goods sold. You start off with, hey, what's the inventory at the beginning of the year? What's the total amount of purchases? Was there any cost of labor? any additional materials and supplies, any other costs, we'll add up all of these lines. Then we would subtract how much we have left over, and that lets us know how much is associated with cost of goods sold for the year. And that cost of goods sold number helps the company to determine what their gross profit is for the year. Next, we have transportation. Transportation, this is essentially, what the individual needed to incur. So some deductible expenses include travel by airplane, rail, bus, the cost of operating and maintaining an automobile. So as it relates to deductible transportation, one thing that's not included is we're going to come to learn is commuting. So if an individual, is commuting, this includes buses, subways, taxis between their home and their principal place of work, it is not considered deductible. And then here we see transportation expense. It may be deducted even if the taxpayer is not technically away from their taxpayer home. Commuting is generally not deductible, but it may be deductible in the following 3 circumstances. So travel between the taxpayer's home and work locations outside of the metro area where the taxpayer lives and normally works, travel between the taxpayer's home and temporary work locations if the taxpayer has a regular place of business, and travel between the taxpayer's home and other regular or temporary locations if the taxpayer's home is the principal place of business. And in all cases, the taxpayer, they can't deduct any additional cost of hauling tools and equipment. So as we see, there are some rules, there are some nuances, some things to keep in mind, because sometimes, again, when you receive the profit and loss from the client, assuming that you do not prepare the profit and loss, you don't keep the books, they have someone else doing it or they do it themselves. These are questions you need to ask, because sometimes they'll have commuting expenses, pretty much bunched in with transportation. You'll have to ask the questions to make sure that as the tax professional, you are not allowing them to deduct expenses that actually are not deductible. So as it relates to transportation, as mentioned earlier, there is a standard mileage rate for miles driven. So for 2024 is 67 cents per mile. So simply stated, for every mile that they drive, they get to deduct a portion. So in the event, let's say an individual drove 1,000 business miles, based on the mileage they drove, 67 cents per mile. So therefore, they get a deduction of $670. The following costs associated with the operation of an automobile are built into the standard mileage rate. So once you take the standard mileage rate, you do not also factor in gasoline and oil, insurance, repairs, and maintenance and depreciation expenses. Those are separate. So that is something to definitely keep in mind, because in the event that you claim the standard mileage rate and also claim gasoline and oil, insurance, repairs, maintenance, depreciation, etc., in such case, you are overstating expenses, ultimately understating net income. There are some deductions that are determined separately. So parking and toll fees related to business transportation, these are considered separate. Any interest on car loans and any personal property taxes, these are considered separate. So there's 2 options, as we're going to learn. There are the standard mileage method, and then there's the actual cost method. When using the standard mileage method, the taxpayer must own or lease the automobile. They cannot operate a fleet of automobiles using 5 or more simultaneously. They will use the straight line method of depreciation when claiming the expense, and they cannot have claimed Section 179 depreciation or bonus depreciation on the automobile. So these are just, again, some things to keep in mind when you are dealing with clients. As mentioned, they can choose a different method, and that's called the actual cost method. So taxpayers, they can change from the standard mileage method to the actual cost method in any year. However, taxpayers that are using the actual cost method, they need to keep adequate cost records using the following formula. So the actual expenses multiplied by the business use percentage. And how do you determine the business use percentage? It is the business miles driven divided by the total miles driven for the year. So assuming that the vehicle is not 100% used for business, because there are some times where individuals, they have a vehicle and they use it for both business and purposes, business and personal purposes. In such case, they would need to allocate to confirm what is the business portion. And vehicle expenses are reported on Form 2106, and then they are carried over to Schedule C or other forms. Next, we move on to travel expenses. So travel expenses are defined as ordinary and necessary expenses incurred when traveling away from home in pursuit of the taxpayer's trade or business. So one key thing to keep in mind, transportation is generally local. Travel is where you are traveling away from home as it relates to the business. So in order to be deductible, travel expenses must be resulted from a documented business reason, including meals. As mentioned, the cost of meals is only 50% deductible. And in the event that an employer reimburses an employee for the cost of meals, the 50% limitation is still going to apply. Next, we have lodging, taxis, tips, laundry. Travel expenses, they are deductible as long as, first and foremost, they need to be substantiated. They are not lavish or extravagant. The taxpayer is away from home overnight. And overnight, it doesn't literally mean 24 hours. What that simply means is that it's defined as a period of time longer than an ordinary workday in which rest or relief from work is going to be required. A tax home is defined as the taxpayer's principal place of business, and it's not necessarily the same location as the family residence. So that's something important to keep in mind, because again, some individuals, they might think, hey, I can't claim this expense because I wasn't away 24 hours. This is another thing to keep in mind. Much like you don't want clients to overstate expenses, you don't want them to miss expenses. So by having this knowledge, you can better educate them so they know what is going to be deductible and what is not. So some expenses of temporary assignments, they are deductible if it's not practical to return home at the end of each day's work. So let's say an individual lives in, New York, and they have a project out in Pennsylvania. In such case, it might not be feasible, because if the individual has to come back to Pennsylvania again in the morning, that's overkill, right? For lack of a better word. So in such case, then it will be considered deductible. It's not practical to return home at the end of each day's work. If there are long-term or indefinite assignments, generally more than 1 year, it may require classification of a new tax home for the taxpayer. If it's a primarily business trip within the U.S., all travel costs to and from the destination are deductible, but only business portion of meals, lodging, local transportation, incidental expenses are deductible. So again, this is where you have to ask the client questions. Hey, while you were away on this trip, did you do anything personal? Let's say they went away to a different state and they took 2 days. Maybe they were there for 5 days, and 2 of the 5 days they went and did personal things. They went to go see family, went to go see a show. In that case, for those 2 personal days, those are not considered deductible. So that is why it is important to ask the right questions. You have to probe. We're not auditors as tax professionals. However, you definitely want to ask the right questions. If it is primarily a business trip that is outside of the U.S., travel costs to and from the destination, they're split between business and personal based on the number of days. If it's 100% business, fine, deduct everything. But again, that's why you need to ask the necessary questions, because sometimes clients aren't as forthcoming, or maybe they don't know. Sometimes people want to, like they say, mix business and pleasure. Any business-related expenses incurred while at the destination are deductible, but the key thing to keep in mind, personal expenses are not deductible. If it's primarily a pleasure trip with or within the United States, travel costs to and from the destination are not deductible. However, any business-related expenses incurred while at the destination, those are considered deductible. So that's the thin line. The thin line is, was it business-related or was it personal? So here we have this example. It says Gabrielle, a sustainability director, travels from Idaho to New Mexico for a business trip and pays $380 for airfare. The lodging and meal costs are $330 and $150 respectively. For the business portion of the trip, while in New Mexico, she goes on a personal sightseeing tour of Turquoise Trail and spends $400 on a car rental and lodging and $85 on meals. What amount may she deduct for business travel? So here's the thing. Since the trip was primarily for business and in the United States, all the airfare is deductible. The lodging of $330 and 50% of the $150 business meals are deductible. However, Going on that personal sightseeing tour, it is not considered deductible. So again, the key thing, was it personal? Was it business related? That determines when it is going to be deductible and when it is not. So there's no deduction for travel expenses to be allowed unless the taxpayer keeps proper records to substantiate the following. What is the amount of each separate expenditure, such as the airfare and the lodging, the departure and the return dates for each trip, and the number of business days on the trip? What's the name and the city or the town of travel destination? And what is the business reason for the travel? So these things need to be clear. Again, we are not auditors, but in the event that IRS, Uncle Sam, decides to probe, you want to be able to help your client. So these are things that you want to let them know up front, because if they can't provide us with the information, they're probably not going to be able to provide Uncle Sam with the information either. Next, we have per diem substantiation. So as it relates to the per diem substantiation, this eliminates the necessity of keeping copious records for travel expenses. Some people, when you go out, a lot of times now, they don't even automatically give you the receipt. You have to ask for the receipt. Why? Because most people don't want it, right? So in such case, per diem basically helps to just avoid that. So employers, they can use the per diem for all travel expenses. This includes lodging, meals, incidentals, or only for meals and incidentals. And either of two per diem methods can be used in order to substantiate travel expenses. So these two methods we have is the standard federal rate method and the high-low method. So again, instead of requiring actual expense records, employers who reimburse their employees for travel expenses, they can choose a per diem method. Per diem is essentially a daily allowance used for business travel expenses whenever an employee is away from their tax home. So when I used to work in corporate America, when I worked for one of the big four accounting firms, we had to travel to another state for training, and they gave us like a company credit card, and they let us know, hey, while you are here each day, you have a maximum of $50 that pretty much could be spent. So the primary advantage of using this per diem method, it helps to substantiate expenses, and it eliminates much of the record keeping that would be involved whenever there are travel expenses. So these are the two IRS approved methods: the standard federal rate method, and the employee is allowed a per diem amount for travel equal to the current federal per diem rate. Varies based on the location, and the location amounts are available. There's a link that shows you, so that way employers have this readily accessible. We have the high-low method. So a small number of locations are designated as high-cost localities, and others are low-cost areas. So it really all depends on where the individual is going. And once the method is chosen by an employer for an employee, it must be used throughout the entire calendar year. So they can't just switch several times throughout the year. Once it is chosen for an employee, it needs to be used for the entire year. Next, we move on to meals and entertainment. So as mentioned, meals, 50%. With the Tax Cuts and Jobs Act, there have been some changes. So there's no deduction for any activity that's considered to be entertainment, amusement, or recreation. This was a very big change because, some corporations, some businesses, they would, wine and dine, have entertainment with their customers. Tax Cuts and Jobs Act came and, basically just overhauled all of that. Any memberships, dues for any clubs organized for business, pleasure, recreation, or social purposes, or if there's a facility that's being used in connection with any of these items. So any entertainment costs related to recreation, social, or similar activities, but it's for the benefit of the employees, those remain deductible. All right. So meals and entertainment, a meal related to an entertainment event is deductible only if the meal is purchased separately. So if both the entertainment and the meal, the cost is combined, unfortunately, you need to, have a way to be able to differentiate between the two, or else it ain't going to be deductible. Because as mentioned, entertainment is no longer allowed. Any dues paid to professional organizations or the civic or public organizations are allowed, but there needs to be a legitimate business deduction Any celebratory meals such as holiday parties and company picnics, those are considered 100% deductible. So meals and entertainment, again, the issue is that sometimes they're so closely aligned. Taxpayers, they should be cautious when they attempt to deduct meals associated with an entertainment event, and client meals whenever the business in which the business is conducted, and if it's not lavish or extravagant, then typically it'll meet that 50% deductibility. So just something to keep in mind. Next, we move on to educational expenses. And again, just keep in mind, obviously there's way more detail as it relates to what is deductible and what isn't. But here we are just scratching the surface. So as you are working with clients, you're going to get a better understanding of exactly, hey, in this situation for taxpayer A, it is going to be deductible, but in this situation, it's not going to be deductible. So just, getting an understanding. Whatever you don't know, there are publications out there. So once you reference, the necessary publication, it'll provide you with everything that you need. So that way you have a better understanding of how, something is going to be treated essentially. And then the great thing about it, anytime, let's say you don't understand something, the IRS has publications that you can use. So here you see for Schedule C, you have the 2024 instructions for Schedule C, very detailed. For the most part, if there's anything that you need information about, you can utilize this publication, utilize the IRS website to get more information. So here we have educational expenses. Here it says, note, tax law for educational expenses is complex as mentioned again. This is just us scratching the surface. So this section deals primarily with the deduction of continuing education expenses incurred by self-employed taxpayers, qualified tuition programs, educational savings accounts, education tax credits, and education loan interest. Those are going to be discussed in other chapters of this text. So educational expenses, it can be deducted if one of two tests are met. The educational expense must be paid to meet the requirements of the taxpayer's employer or the requirements of law or regulation for keeping the taxpayer's salary, status, or job. And the educational expense, it must be paid to maintain or improve the existing skills required in performing the duties of the taxpayer's resident work. So once the educational expenses meet one of the above tests, they have a bona fide purpose, then in such case, they can be deducted even if it leads to a college degree. So as it's required by the employer or law, taxpayers required to meet educational standards beyond minimum requirements, they may deduct the expenses of the education. So this is like CPE for certain professions. You need to have, or you need to acquire CPE, continuing professional education, during the year. Expenses of travel for education purposes, travel expenses incurred while away from home for trips that are primarily to obtain qualifying education. These are considered deductible. So here we have this quick example. It says Roxanne is a paralegal. She attends law school at night at the University of Texas at El Paso. Are her educational expenses deductible? And it states, assume that 30 hours per year of continuing education is required to maintain a certification in Texas. If Roxanne flew from her home in El Paso to a continuing education conference for paralegals in Dallas, are her expenses deductible? So the solution, the cost of attending law school are non-deductible, because the education will qualify Roxanne for a new trade or business as an attorney. Her expenses at the conference, however, would be deductible. Meals, as we know, limited to 50%, since she is complying with the requirements to maintain her existing job. So again, you want to have a clear understanding of these nuances, so that way you are not, informing your clients of deducting things that they actually cannot deduct. Next, we have dues, subscriptions, and publications. So as it relates to dues, subscriptions, and publications, these, would apply to, professionals, doctors, lawyers, accountants, etc. They're engaged in practice or employed, and they may deduct the cost of related dues, subscriptions, and publications. So this includes any dues to professional associations, and any cost of subscriptions to any journal that is directly related to the taxpayer's profession. So included in this category would be, let's say, a lawyer, right? They essentially have membership to the local bar association, or for CPA, certified public accountants, their dues to the American Institute of Certified Public Accountants. The cost of subscriptions is many, as mentioned, as it relates to the profession. So in such case, they can deduct it. Employees, however, just keep in mind with the changes to the Tax Cuts and Jobs Act, unfortunately, because of the expansion, they are no longer allowed to deduct it. Next, we have special clothing and uniforms. Special clothing and uniforms are deductible for self-employed individuals and employers if they are required as a condition of employment and they are not suitable for everyday use. So sometimes you essentially have individuals that they'll say, hey, I purchased these black pants for a job. Like I work with estheticians and people in different professions, and it's like, is this suitable for everyday use? It actually is. So unfortunately, it's not considered deductible. So self-employed individuals and employers, they are allowed a deduction for the cost of special work, clothing, and uniforms, but the deduction is not allowed for the general cost and upkeep of normal work clothes. So the clothing must be specialized. And in order to be deductible, as we see here, must be required as a condition of employment and not suitable for everyday use. Both conditions, they need to be met for the deduction to be allowed. It's not enough that the taxpayer is required to wear special clothing if it can be worn while the taxpayer is not at a job. So the cost of protecting clothing, so like safety shoes, hard hats, rubber boots required for the job, these are also considered deductible. And if the clothing or the uniforms, if they do actually qualify, the cost of the purchase, any alterations, any laundry, in such case, they are going to be considered deductible. And again, as it relates to employees, because of the changes to the Tax Cuts and Jobs Act, they are no longer allowed to get a deduction as an employee, but self-employed individuals do have that benefit. Next, we move on to business gifts. So within limits, taxpayers are allowed a deduction for business gifts. Salespersons and other taxpayers, they can deduct up to $25 per year per donee. And for this limitation, just keep in mind, spouses count as one donee. So just keep that in mind. Unless the spouse is also a client, then in such case, the spouses can receive separate $25 gifts. And here you see plus the cost of gift wrapping and shipping per donee per year. There's no limitation for small business gifts of up to $4 if the taxpayer's name or company name is printed on the gift item. So maybe if there's a mug or if there's a pen or a notebook or things of that nature. A deduction for gifts of tangible personal property made to employees for the length of service on the job and safety achievement, it can be deducted up to a limit of $400 per employee per year. And if the gift is made in conjunction with a qualified plan, the limit is $1,600. And gifts to taxpayer supervisors are not considered deductible. Sole proprietors, they can make charitable contributions to qualifying organizations, and business charitable contributions, they are not reported as business expenses. However, they are going to be reported as an itemized deduction. And obviously, depending on the taxpayer situation, whether or not they itemize, that ultimately is going to determine if it is deductible or not. As it relates to the substantiation requirement, so taxpayers, they must be able to substantiate these aspects of the deduction. What was the amount of the expense? What was the date? And the description of what was given? Was there a business purpose? What is the business relationship? So there are some key requirements in order for these gifts, quote unquote, in order for it to be deductible. Next, we have bad debts. So bad debt is mentioned. This is essentially whenever a taxpayer sells goods or services on credit and the accounts receivable, it becomes worthless, uncollectible. So long story short, or simply stated, the customer isn't going to pay you pretty much. So a bad debt is allowed to the extent that the income was previously reported. So if an individual is on a cash basis, this isn't going to apply. Why? They never reported the income anyway, right? However, if they are under the accrual basis method of accounting, where it doesn't matter when you receive the money, the key thing is when did you perform the service? That means you earned it. In such case, for accrual basis taxpayers, they would report it, or those that have a hybrid method where they're mostly cash basis, but they do account for accounts receivable. So taxpayers, they must use the specific charge-off method. The IRS requires proof that the debt is worthless as well as the amount of the worthlessness. So we have business and non-business bad debts. So debts that arise from a taxpayer's trade or business, these are classified as business bad debts, which are ordinary deductions. All other debts are considered non-business bad debts and considered short-term capital losses. And these are netted against other capital gains and losses and subjected to a $3,000 per year limitation. So here we have this example. We have Kiko, a dentist, loaned a friend, Lucas, $20,000 to start an upholstery business. Subsequently, Lucas cannot repay Kiko. Is this going to be considered a business or a non-business bad debt? And how much can Kiko deduct in the current year? So this is going to be considered a non-business bad debt. Unfortunately, Kiko is not in the business of lending money, and it is going to be considered a short-term capital loss, and it's going to be limited to the $3,000 deduction against ordinary income in any 1 year. So it's going to take Kiko several years to write off this loss. It is treated similar to a capital loss. Next, we have a home office. So as it relates to home office, some individuals, they work and they'll operate a trade or business in their home, and that qualifies for a home office deduction. One key thing to keep in mind is that the tax law does impose strict limits on the availability of the deduction. And in fact, the deduction for an office in the house is office and home, or home office is allowed by exception. The general rule for a home office deduction states that a taxpayer is not allowed a deduction for the use of a dwelling unit that's used by the taxpayer as a residence. However, there are 4 exceptions to the general rule. So it's used by the self-employed taxpayer as the principal place of business. It's used exclusively and on a regular basis by patients, clients, or customers in meetings or dealings in the normal course of the trade or business. A separate structure not attached to the dwelling unit, and it's used exclusively and on a regular basis in the taxpayer's trade or business. And the storage space of business inventory or product samples, that's what the space is used for. So there are some income limitations. The home office deduction cannot be used to create a net loss for the business, with the exception of allocable mortgage interest and property taxes. So some other operating costs included in a home office allocation includes rent, home insurance, repairs, cleaning, utilities and other services, homeowners association dues, and depreciation on the cost of home. So you don't basically lose it. What happens is that it's going to be carried forward to offset income in future years. So we have this quick example. Kiara, she's a part-time cartographer, maintains a home office where she coordinates projects and keeps client records. She allocates $12,000 in mortgage interest and taxes to her home office and collects $11,000 in fees. Assuming there's no other business expenses, what is her current year home office deduction? Will she have a home office carry forward? And how do things change if she also allocated $2,500 in maintenance and utilities? So assuming there's no other business expenses for the current year, Kiara's will be able to take the entire $12,000. Why? Because it's based on mortgage interest and taxes. However, in the event that there was also $2,500 in maintenance and utilities, she would not be able to claim any of it. So home office expenses do not create a loss, with the exception, as mentioned, of mortgage interest. So the home office allocation would be determined as follows. It's a calculation of the home office expenses involved. It will be the home office square footage divided by the total home square footage. So let's say that the total square footage of the home is 1,000 and the home office square footage is 300. In such case, the individual will be able to take 30%. And self-employed taxpayers that claim a deduction for home office expenses, they're required to file Form 8829, which reports expenses for the business use of your home. Another method that individuals can use is the optional safe harbor method. So this is a more simplified option, and a simplified home office deduction is available. And this allows taxpayers to take $5 per square foot as a home office deduction, and there's a maximum of $1,500. Any deduction in excess of the income limit is not going to be carried forward when this safe harbor method is utilized. So this brings us to the last few slides, hobby losses. Under the hobby loss provisions, taxpayers are not allowed to show a loss from an activity that is not engaged in for profit. So as mentioned, generally for a trade or business, the tax law determines that this is essentially, an activity that you're engaged in for profit. So if a taxpayer enters into an activity without a profit motive, then the tax law limits the amount of the tax deductions available. They don't treat it as a business. Instead, it is treated as a hobby. So hobby income is reported as other income on line 8J of Schedule 1 of Form 1040. So obviously this is other income. It's not self-employed. So therefore, they are not subjected to self-employment taxes. So some operational rules, taxpayers, they can avoid hobby loss rules by using some factors to determine the profit motives, because the big issue here is that a lot of times individuals, they, let's say they're working a W-2 job, they will have a Schedule C, and sometimes people actually have business losses, right? But in other cases, sometimes they will inflate or artificially create business losses because the loss can offset any other income, ultimately reducing your taxable income, ultimately reducing your tax liability. So in such case, in the event that, let's say, Uncle Sam sees, hey, this individual is continually, recognizing a loss, in such case, then there's a likelihood that Uncle Sam will start to probe to say, hey, you're not having a profit, in this business. Maybe this should be treated as a hobby, which ultimately limits the amount of expenses that can be claimed. Therefore, there would be no loss allowed to take. So tax law provides a rebuttal presumption that if the taxpayer can show profit from the activity for 3 out of the 5 previous years, 2 of the 7 previous years for activities that involve horses, then the activity is engaged for profit. So there's a loss limitation. Miscellaneous hobby expenses are no longer deductible. So these are some things to definitely keep in mind. So there was a lot covered in this chapter for business income and expenses. So now that this lesson has ended, you should have learned how to complete a basic Schedule C. As we saw the visualization, there are 5 parts of the Schedule C, and just keep it in mind, again, how you actually handle them. Part 1 covers income, Part 2 covers the expenses, Part 3 covers the cost of goods sold, Part 4 covers vehicle information, and Part 5 covers other expenses. We described the tax treatment of inventories and cost of goods sold. We identified the requirements for deducting transportation expenses. We also looked at deducting travel expenses, deductibility of meals. We also looked at claiming business education expenses. There was a lot of, objectives. We also discussed identifying the tax treatment of dues and subscriptions, determining which clothing and uniforms can be treated as deductions. We explained the special limits for business gift deductions, the tax treatment of bad debt deductions, when is a home office deduction allowed and how it is computed. And lastly, applying the factors used to determine whether an activity is a hobby and understand the tax treatment of hobby losses. So this brings us to the end of chapter 3, business income and expenses.